This year, the standards to what was once considered normal have been constantly disrupted and reshaped. But for some sectors of our economy, the greatest trouble hasn't even started yet. That's the struggle thousands of U.S. commercial real estate owners are about to face early next year. In 2020, property owners have seen their buildings shut down during several rounds of restrictions, leaving many of their tenants unable to afford their back rent, making the whole sector question the practicality of its own operations. As the remote work trend gains force and travel and tourism continue to be impaired by the fallout of the health crisis, in addition to the progressive bankruptcy of retailers, restaurants, and hotels, commercial real estate space has been sitting empty. While on the other hand, mortgage-based securities keep falling into delinquency. The latest evaluations of the sector are leading strategists to worry about the enormous financial distress these owners will have to cope with over the next months, which could potentially result in a catastrophic banking crisis, considering their credit is already compromised and the economic outlook doesn't look promising enough for owners to regain their ability to pay off their debt. But so far, the commercial real estate market hasn't really had a reckoning. However, experts warn that this is set for a change. That's what we're going to investigate in today's video. So, welcome to today's Epic Economist video. Don't forget to give this video a thumbs up, share it with your friends, and subscribe to our channel to keep updated with future videos. All across the country, offices, restaurants, gyms, stores, and hotel rooms are getting increasingly vacant due to the new round of lockdowns. The sanitary outbreak has prompted a major relocation of the masses, driving people to fly away from metropolitan areas seeking more affordable housing and escape from the mounting social turbulence we've all been witnessing over the course of the year. Cities are being hollowed out due to the shift to remote working, the preference for online shopping, and the obstacles surrounding business and touristic traveling. That has caused a huge shock to commercial properties of almost all descriptions. 12 years after the last housing and mortgage markets collapsed, the U.S. commercial real estate market seems to be headed to a financial cliff not seen since the Great Depression, and strategists are already on the lookout for a potential new banking crisis induced by the growing upheaval in the sector. "I think it's gonna be a two-headed monster," alerted Pat Jackson, Chief Executive Officer and founder of Sabal Capital Partners in California, about the outlook for struggling commercial buildings. He explained that although some assets may perform relatively well due to the elevated demand for family housing, on the flip side, there's a lot of distress, and it's coming. Jackson, who was a lender and investor in billions of dollars worth of battered assets during the last recession, says that properties are running out of runway after almost a year of business interruptions. While the sanitary outbreak continues to spiral out of control, even the arrival and distribution of a vaccine won't swiftly reverse the damage the markets have experienced, especially considering that every new wave of the virus pushes us further away from the possibility of a smooth economic recovery, and at the same time, it sparks even more fear amongst banking regulators, who at this point have reason to anticipate the many risks the financial system is about to face, which might crack down on banks and other segments exposed to the deterioration of the real estate market. This is something that could make a bad situation worse, maintained Adam Slater, lead economist for Oxford Economists in London, in an interview with the Washington Post. "What we don't want is to get really nasty stresses and strains in the financial system from something like this," he added. His concerns are also shared by several market watchers who've been examining the growing reserves that U.S. banks are setting aside to prepare for future losses that might sum up to $2 trillion in commercial real estate loans. Additionally, the imminent threat of bankruptcies and defaults has already led banks to tighten credit and lending, which means commercial borrowers are likely to face even bigger hardships to access the loans and to refinance their debt to weather the coming storm. Recent Federal Reserve data suggests that the overall stakes have never been higher. Nationwide, commercial property debt skyrocketed to a record high of $3.06 trillion in the third quarter from a 10-year low of $2.2 trillion in 2012. In some states, such as New York, the situation is way more complicated. With approximately $1.1 billion worth of property loans now considered distressed in Times Square, the latest property evaluation indicated that the value of property has been slashed by 80% to about $92.5 million, according to the real estate data platform Credic. That's why owners have been rushing to make an effort to prevent a massive collapse in property prices. The New York Times reported that, in a sign of the times, New York City's reeling commercial real estate business recently put forth a proposal to turn some 1 million square feet of Manhattan office space into housing. That was kind of an eye-opener to see how much the value had dropped, stated Credic co-founder Bill Peterson. Apparently, there will be no quick fix that could stop the bleeding of the commercial real estate market. The Financial Times projected that even after the vaccine is largely distributed, nothing could really provide an instant relief to New York City's comatose $4 billion hotel mortgage sector. The article described that currently, the Big Apple's overbuilt hotel industry has a large exodus of vacant rooms, with 4 out of 5 properties backed by hotel mortgage bonds now presenting signs of strain. In this sense, it is understandable why the chief executive of the Hotel Association of New York City, Vijay Dandapani, told the FT that if only half of the city's 640 hotels survive, that will be already a great outcome. But hotels aren't the only ones in deep trouble. Evidently, tourism-related properties have felt the consequences of the restrictions harder than other segments. However, eventually, traveling will be resumed. So, hotel rooms will once again be occupied, and business events and social gatherings will help owners to make up for lost revenue. By contrast, the retail apocalypse has provoked a major crunch in commercial real estate, and since a considerable amount of those stores were permanently closed, that will create a glut of retail space in a country that already had too much of it. Moreover, the rise of e-commerce has largely contributed to the downfall of U.S. shopping malls. Up until now, the owners of 2 sizable portfolios of over 130 shopping malls have filed for bankruptcy after a series of stores and restaurants either shut down their activities or lost their means to pay their rent. The Missouri-based real estate broker John has outlined that the sanitary outbreak was the ultimate coup for a sector that was already in free fall. On Black Friday, which is known as the traditional start of the holiday shopping season, foot traffic declined over 70% at shopping malls as public turned to online Christmas shopping this year, reported the S&P Global data. Retail will remain just a mess. Hospitality will have a very challenging year, and in more isolated instances, offices will be problematic, warned Dave Bragg, a managing director at real estate research firm Green Street. Now that employers realize the unnecessary high costs of the maintenance of office spaces, as well as the effectiveness of working from home, companies have been revealing plans to reduce their need for working facilities, either due to staff cutbacks or because of a greater adoption of permanent home office operations. Different from past property market crashes, which were generated by excesses and exuberance in the financial markets, the health crisis has changed real estate fundamentals by readapting how we lead our lives. Remote working has made it possible for people to leave high-cost areas like New York and San Francisco to find less tumultuous locations to establish themselves and their families. Conversely, apartment markets have started to show their open wounds, rising vacancies and falling rents. Multiple leading companies are announcing an inevitable shift to remote working. Deutsche Bank is formulating a plan where employees would spend 2 days a week at home, while Facebook has affirmed that half of its workforce could be remote over the next decade. In short, office owners in many high-cost areas are going to have to get used to higher vacancy rates, since things won't probably ever come back to normal. The commercial real estate services firm Cushman & Wakefield informed that whereas 24% of all hotel loans and 18% of all retail loans sold in the commercial mortgage-based securities market fell into delinquency in June, only 2.7% of office building loans suffered the same fate. But that doesn't mean the deterioration of the office segment is going to be any less impactful than the decay of other commercial properties. In fact, according to Jason Van Zlet, a mortgage foreclosure litigation specialist, it takes a lot longer for an office building owner to default on a loan because owners sign leases with numerous tenants and a significant amount of them would have to stop paying rent at the same time for owners to get in trouble with lenders. Still, the slowing economy from the fallout of the virus outbreak and the existential question of whether employees can continue working from home over the long term means the office sector will continue to struggle for the next 2 years, Van Zlet explained. Likewise, the director of Janney Montgomery Scott, a financial advisory firm based in Atlanta, highlighted that the office market, it's like a slow-motion car wreck, and he sees heavy uncertainty on the future demand for office space. At this stage of the downturn, roughly 14% of all U.S. office space is vacant, and that's a 12.8% increase from last year. Vacancy rates are anticipated to reach at least 17% by 2022, and that's according to a Cushman & Wakefield forecast, levels not seen since the Great Recession. Furthermore, rental prices of office properties are also expected to fall by more than 5% in large cities, including Chicago, Philadelphia, and San Francisco, due to the decreasing demand and high dependence on mass transportation, making these areas more vulnerable to the relocation of residents and companies. For that reason, by early 2021, fire sales of commercial buildings are expected to happen just as seen during the previous mortgage crisis. Property owners who've been delinquent on their payments for months will have to find ways to put money into their buildings, sell at distressed prices, or hand their keys back to the bank. Keeping in mind the staggering $430 billion commercial and multifamily real estate debt is going to mature in 2021, lenders and borrowers will be forced to decide what buildings are worth being saved in a world that has been forever reshaped by a ravaging viral outbreak. That period of "let's just put a Band-Aid on it" is more or less coming to a conclusion, signals Wendy Silverstein, a former executive with Vornado Realty Trust. There's a lot of collateral damage that's going to be hanging around for a while, she completed. As we enter the darker stage of the economic meltdown for multiple business sectors, the losses suffered have the potential to ripple far beyond building owners and their tenants. Considering commercial property upholds the tax base in several cities across the nation, a collapse in the real estate market will not only cause a banking crisis, as it will strike local budgets. In other words, this will be translated into much more economic challenges ahead, and possibly the extension of this never-ending recession that doesn't cease to impair our life prospects and jeopardize our standards of living. America is doomed to an ominous future, and we are all going down with it.